So I want to switch over to a subject dear to my heart, or because we spent some time researching this, which is private equity. And you might not know much about how private equity works, but David talked about companies or portfolios built by Canadian pension funds, which I'm going to go into in a second, where a significant part of their portfolio is not invested in the public markets, which means, in this case of companies, private companies. So why do private equity firms invest in private companies? Well, first off, they're typically paying less than half as much in terms of a multiple of earnings for a private company as they would pay for a public company. So from their perspective, they're simply buying these companies for less money per dollar of cash flow. They plan to typically work with those companies and develop an exit where they can sell within 5 to 7 years. They want to grow the sales and the net income, so that means they've got to be actively involved in the management. They charge much higher fees because they believe they're getting much higher results, and we'll look at those results in a second. These are higher risk assets, lower liquidity assets, and so the question is, number one, is it appropriate for you to do it? And number two, where would it fit in? Okay, so a couple of things that might be helpful. There's a group out of New York, now in Canada, of relatively wealthy individuals. You have to have $10 million of investable assets to, quote, get in the club, and these people share investment ideas with each other. Their investment mix that's invested in private equity is about 10% of their total assets, and real estate is about 25%. If we compare that to a study that came out 2 weeks ago in Barron's magazine, JP Morgan said, what are we doing for our high net worth clients? Well, first off, much like a lot of these other models you've heard about today, they're only 31% in equities, and they've allocated 5% to private equity. So still, by far, much less than it would be in the public markets, but a reasonable allocation. We talked about these other institutions, and David talked about the returns they make. Let's just look at what they're doing in private equity. So the Canada Pension Plan Investment Board has a 53% allocation to equities, but 16% of that is in private equity. So if I compare that to the other pensions and some of the other pensions that were mentioned, the Caisse de Depot has $15 billion of their portfolio in private equity. BCIMC has got $5 billion, and AIM, which is the Alberta Investment Management, has about $2 billion. So all of these pension funds believe that they should have money in this space. And what is their objective? They're trying to achieve a real rate of return of 4 to 5% a year, and they're investing this money to provide indexed income for life for their millions of beneficiaries. So they have a serious fiduciary responsibility, and they believe strongly, and I believe they're correct, that in order to hit all their targets for their clients, they've got to have this type of diversification and this kind of investment at least to 5 to 10% of their portfolio. Just recently, The Economist magazine had this incredibly glowing article about how great Canadian pension funds are. What you might not realize, and I'm just going to read this, this is the global ranking. So they're looking at 330 pensions around the world, major pensions around the world, and these 4 pensions, all Canadian, are in the top 40. In fact, 6 of the top leveraged buyouts of all time in the history of finance involved Canadian pension funds. The Ontario Teachers is the top 10-year performing fund out of the 330 funds that were in the survey. Their long-term horizon for investment, and they have less need for liquidity, which means they're willing to invest not just in private equity, in infrastructure, and in real estate as well. In all cases, they're deciding to make an investment based on the cash flow that it generates. So it's important to realize that a lot of pension funds with very conservative mandates, in other words, high responsibilities to their beneficiaries, are investing in private equity. So we've made a decision to create our own private equity pool, and our objective is to develop an advisory board that will help us make co-investments, but primarily what we're trying to do is build a fund where we invest in other private equity pools, and there's a risk reason for doing this. So if you want to take a look in Canada how private equity is done, you can see this chart here. The private equity industry, up until the end of 2009, outperformed the marketplace by almost 10% a year over 10 years. And if you take a look at some of the firms that we will be investing with, these are their rates of return over 20 years, 10 years, 5 years, and 3 years. The biggest reason that we're looking at a fund of funds is in this last slide here, right there. If you invest in a single company, your chances, according to the statistics that we've looked at, of losing some of your money in a single private company are about 40%, and there's about a 30% chance you'd lose 100% of your money. If you invested in 10 or 20 companies, as a private equity pool would typically do, you reduce that risk of losing all your money to maybe 1%. And you reduce it even further to virtually 0% if you invest in a fund of funds that's diversified geographically and also in terms of size of company. And that's basically what we're trying to accomplish here. Now, there's something else I wanted to share with you as well. There's an article in Fortune magazine written just recently by Warren Buffett. You may have seen it. And he's trying to make an argument in the article why he doesn't invest in bonds and he doesn't invest in gold. He invests in stocks. Now, the problem is the title of the article is a bit misleading. What he says in the article is, in fact, he invests in real estate, in infrastructure, in private equity, and in public equity, but in each case he invests in assets where he can count on a certain level of cash flow, and he likes these assets more than he likes fixed income, and he's now referring to today's interest environment and gold. So the way he framed it is he said, all right, let's see if we can make a decision. So I don't know why we're all doing baseball today, but this is another baseball analogy. So he said, just if you could take all the gold that was ever mined in human history and all the gold that's in jewelry and put it all together in a giant cube, it would be a cube that would be basically 60 feet by 60 feet by 60 feet. It would weigh 130,000 tons, and it would be worth $9 trillion. And it would generate no income, of course. And it would be a great store of value, and it would have performed very well over the last 10 years. So he said, all right, so let's say we're going shopping, because we have $9 trillion, and we have some alternatives. What can we buy with $9 trillion? He said, well, the first thing you can do is you can buy 400 million acres of farmland, which is all the farmland in the United States. You can also buy, included with that, 16 Exxons. And if you buy them together, you end up with $8 trillion invested, with $1 trillion left over, and $700 billion of cash flow each year. So the question really is this: if you had a choice between these two investments, which one would you pick in terms of how you think it's going to perform over the next 20 years? It's an interesting question.